everyone, and welcome to today's NOVA presentation, Preparing for Roth Catch-Ups in 2026, hosted by David Thorogood. Before we get started, I'd like to go over a few housekeeping items. First, please note the question mark icon at the top of the webinar screen. This is where you can enter any questions you may have throughout the presentation. The Q&A portion will be held at the end if time allows. If we run out of time and your question isn't addressed, please feel free to email us at webinars@nova401k.com. and we will make sure to get you an answer. Right next to the question icon, you'll see a paper icon. This is the handouts dropdown where you can find today's material in PDF form. If you're unable to view or download the handout, just send us an email and we'll be happy to provide the PDF directly to you. To view past webinars or to watch today's recording of today's session, you can follow us on our YouTube channel, Nova 401k Associates, or visit our website at www.nova401k.com/webinars. Thank you again for joining us, and now I'd like to introduce today's presenter, Senior Account Manager, David Thorogood.
Thank you for that, Ava. I appreciate that. And good morning to everyone, or good afternoon if you're on the East Coast. And thank you for joining today. So we are going to be talking about preparing for Roth catch-ups beginning in 2026. So real quick, we'll go to the next screen. We'll have a disclaimer for you. The information in this presentation is general in nature and not intended to be a substitute for legal or tax advice. Please consult a qualified professional, such as an attorney or an accountant, if you need legal advice. All right, next slide. All right, what's on our agenda for today? So we're going to talk about the new 2026 limits, which have just recently come out from the IRS. Usually they come out a little bit earlier, but they were a little bit late because of the government shutdown earlier this year. And so we do have those out. We'll go over those. We're going to talk about what exactly are Roth contributions, the difference between actual Roth and after tax. And then we're going to talk about the new Roth catch-up regulations and what NOVA has done to prepare for the new regulations and what plan sponsor action items need to be taken and what any action items the participants need to take on their behalf as well. So we still have the slides up. Just want to check with Ava on that. Good. All right, next slide. So new limits for 2026. So the 402G annual limit, 402G is the section of the code that sets the limits for the year. So these are the deferral limits. For 26, the total deferral that you can put in, which includes pre-tax and Roth deferrals during a calendar year, is $24,500. That's up from $23,500. So on the catch-up contributions, $8,000 are available now to participant age 50 or greater. Now for 2025, the catch-up, or when it was now super catch-ups for age 60 to 63, is $11,250. And this is applicable for anyone who is age 60 to 63. However, if you turn 64 during the calendar year, you are no longer eligible for the super catch-up, and vice versa. If you turn 60 during a calendar year, let's say for instance January 2nd, or let's say the calendar year you turn 60 on December 28th, you're eligible for the full super catch-up for that calendar year. Then we have the annual limits. That's $72,000 plus any additional catch-up that you're eligible for. And the annual limit is the total amount that can be attributed to a participant's account during the plan year. This includes their deferrals, match, profit sharing, any reallocated forfeitures as well. All right, moving on. So here's a little better shot of the new limits by age. So for elective deferrals, which include Roth and pre-tax, under 50, it's $24,500. 50 to 59, $32,500. 60 to 63 goes to $35,750. And then once you're 64, you drop back down to $32,500. And those particular limits basically move forward onto the annual additional limits as well. It's $72,000 plus catch-up, and then there's plus super catch-up of $83,250. And then you become 64 or older, it drops back down to $80,000. And then some other limits that were addressed were the annual compensation limit. This is the total amount of compensation that can be used during the year when we do our annual testing, calculate profit sharings, and do other allocations. Now, highly compensated employees, HCEs, the 2026 limit is going to be $160,000. So for anyone that is 160,000, makes 160 more in 2025 will be considered an HCE for the 2025 testing that's done in 26. Now, the new one we're going to talk about, the new limit, is for highly paid individuals, or HPIs. And that limit is $150,000. Now, that's the 2025 limit. Okay, so let's move forward here now. Okay. Now let's talk about Roth contributions a little bit. So Roth contributions came from the Economic Growth and Tax Relief Reconciliation Act, or as we call it in the retirement industry, EGTRA. And this introduced the Roth 401k provision, which became permanent with the Pension Protection Act of 2006. Now in 2023, Secure 2.0, which was a very large and robust act that was signed, made Roth catch-ups for highly paid individuals mandatory. So it's not an option. So people would say, well, if you're adding super catch-ups and you keep raising the deferral limit and you raise the catch-up, the normal catch-up, why did Congress make the Roth catch-up provision mandatory? Well, whether there's a bill introduced into the House or the Senate, every bill goes through compromise. Okay, and so the IRS certainly is saying, okay, well, we're going to give them additional deferral limits. We're going to have super catch-ups, but we need the revenue. So any Roth catch-up is going to be required to be, any catch-up contributions for people who qualify, highly paid individuals, is going to be Roth. Now, Roth contributions are not the same as after-tax contributions, and we'll cover that in a minute. So, trivia question, why is the word Roth capitalized? All right, next slide. So the answer, the original Roth legislation, the Roth IRA, introduced by Senator William B. Roth, Jr. of Delaware. He was the chairman of the Senate Finance Committee at the time. And so now that you know that, I'm sure you will all be a hit at dinner parties that you know why Roth is capitalized. So let's cover Roth or after-tax right quick. Both the contributions are made with after-tax dollars, but there are significant differences. The gains on after-tax contributions are taxable at the time of distribution. That's pure after-tax contributions. The gains on Roth contributions are not taxable if the 5-year rule is met. We'll cover that next. In addition, after-tax dollars are not subject to the annual 402G deferral limit, but subject to the annual limit of the $72,000 for 2026. Because, unlike Roth contributions, after-tax contributions are not deferrals. And as a result, they're also subject to the ACP discrimination testing. So having pure after-tax contributions in a plan sometimes can be very difficult from a testing perspective. All right, moving on. Quick little Roth versus after-tax comparison chart. So taxes on the contributions. Well, for Roth, contributions are after tax, and for after-tax contributions are after tax. What about the withdrawals? Well, for Roth, withdrawals are tax-free as long as the requirements are met. We'll get to the 5-year requirement in a minute. After-tax contributions. The earnings on after-tax contributions are taxed as ordinary income. And we covered the limits earlier, but here's the same. With the Roth, it's $24,005 and $32,500 with catch-up. After-tax pure, it's $72,000 and $80,000 with catch-up. And what about rollovers? Contributions and earnings of Roth can be rolled over into a Roth IRA. Now, after-tax contributions, the contributions can be rolled over into a Roth IRA, but the earnings have to be converted to Roth. And once that takes place, they're subject to income tax. All right, moving on. Pardon me. So let's talk about the Roth 5-year rule. Like I mentioned, earnings on Roth contributions are not subject to income tax if the Roth account is not distributed for 5 years. And the initial contribution to the account is considered the basis for the Roth. Now, wondering, when does that take place? The 5-year period begins on January 1st of the year of that first contribution that's made. So if you decide you want to start making contributions in late November and you change from pre-tax to Roth contributions, the basis on those Roth contributions is going to be January 1 and not November. So you pick up almost a whole year there of the 5-year rule. So after that, distributions of a Roth account is considered a non-qualified distribution if made before age 59 and a half. And the, excuse me, and the earnings are taxable even if the 5-year period has been met. So not only do you have to pay taxes on those earnings, but you also have to pay the 10% penalty that's associated with early withdrawal from a retirement plan. So it's very important that if you do make Roth contributions, that you're planning on leaving it in there for at least 5 years to get the full benefit of the Roth, and that you don't take a distribution until after age 59 and a half. Now, one thing about the 5-year rule, a lot of 401k plans allow in-plan Roth conversions. We'll talk about that in a minute. But each time you do an in-plan Roth conversion from pre-tax to Roth, you start another basis. You start another 5-year clock for that Roth contribution. Okay, moving forward. Now, in-plan Roth conversions. Like I said, if the document allows for an in-plan conversion, it must also allow for Roth deferrals. Making sense, wouldn't it? If you want to convert your pre-tax to Roth, the document has to be set up so that it will include Roth deferrals as an option. And I believe most of you on this call do have the Roth deferral feature in your document. Now, it's not limited to just the original participant. Anyone, plan participants obviously, but a surviving spouse beneficiary, and even an alternate payee, someone that has the account now in the plan due to a quadro or qualified domestic relations order as a result of a divorce. Now, in-plan Roth conversions only work one way, and oddly enough, I have gotten this question on a couple of occasions. If you convert pre-tax to Roth, and then you have your money in the Roth account, can you convert the Roth back to pre-tax? No, can't do that, because you already paid tax on that Roth, because you converted it from pre-tax to after-tax. So you're going to get a 1099-R at the end of the year to pay tax on it. And if we were convert it back to pre-tax, the IRS is not going to give you money back. So it doesn't work that way. All right. Next slide, please. Okay. Highly compensated employees. This term has been around for quite some time. The HCE, and it identifies those individuals for certain testing purposes. So highly compensated employees are always identified for use in ADP discrimination testing, coverage testing, profit sharing calculations, and other tests. Now, who is a highly compensated employee? Anyone who is a more than 5% of the plan, 5% or more owner of the plan sponsoring entity. Now, this includes family attribution rules, which means that children, parents, or spouses of an HCE are also considered an HCE, regardless of compensation. So you have someone that's a more than 5% owner, and he has a daughter that's 19 years old, and he's paying her $24,000 a year. She's considered an HCE for testing purposes, and sometimes can have a very dramatic effect on those tests. So for anyone that made $155,000 or more in the 2025 plan year, which is coming to an end very quickly, is going to be an HCE for 2000. HCE. It does apply for a grandchild to a grandparent, but not for a grandparent to a grandchild. Now, depending on the ownership percentage, there's some other things, but as a general rule, it does not apply. All right, moving on. Roth catch-up contributions for highly paid individuals. Okay, Here's the crux of the biscuit, you might say. So this is effective for plan years beginning after December 31, 2025. So all plan years beginning January 1, 2026 are subject to these new requirements. Now, before the final regulations came out mid-September, there was still some thought that they would push this off for everyone until plan years beginning January 1, 2027. But the only plan sponsors they did that for were sponsors that have government or union plans that are not required to designate Roth catch-ups for HPIs until after December 31, 2026. So if you're out there as a plan sponsor and you have a governmental plan or a union plan, you get a break for a year. So that's basically what it boils down to. Now, how do we define an HPI, a highly paid individual? Is someone that has compensation exceeding $150,000 in FICA wages. It's box 3 of the W-2 in the prior year, subject to the cost of living adjustments. So what does that mean for 2026? So anyone that has FICA wages of more than $150,000 in 2025 is subject to the Roth catch-up rules beginning January 2026. Now, this is all based on box 3 of the W-2. It's not gross pay or anything like that. Partners and sole proprietors, Schedule C, K1 income, do not receive a W-2. So they don't have a box 3. And as such, they're not subject to the Roth catch-up mandates as they have no FICA wages at all. In addition, the family attribution rules we talked about regarding HCEs does not apply to HPIs. Now, on the $150,000, this is the amount that they exceed this in FICA wages. You might have gotten some literature from us regarding a Roth catch-up limit at $145,000. Well, the reason being the final 2.0 regulations regarding Roth catch-up contributions were issued on September 16th and had the Roth catch-up limit at $145,000. But the IRS plan limits introduced on November 13 changed the limit in a twist retroactively to $150,000. So if you have anything that has $145,000 on it regarding Roth catch-up contributions, mark it out and put $150,000 on it. All right, moving on. More Roth catch-up contributions for HPIs. Plans must have a Roth deferral provision or catch-up contributions cannot be allowed for HPIs. Now, I believe all of you, like I mentioned, have that Roth deferral provision, but since catch-ups for HEIs have to be Roth, your plan has to have Roth deferrals in the plan. And I like to remind people, they look at the tax benefits of pre-tax and not Roth, but with the Roth benefits, number one, you get very favorable tax treatment on the earnings if the distribution is qualified. Qualified distribution of Roth, once again, you meet the 5-year rule and you're 59 and a half or older. Now, for the ease of administration, there was a lot of talk about could a plan be amended to make all catch-up contributions as a Roth, so you wouldn't necessarily have to identify HPIs. And the IRS came out on that and said, no, you can't do that because you're reducing a benefit that has been given to all those others that had the capability to make pre-tax contributions and not Roth. And the in-plan Roth provision should be provisioned in the plan to correct HPI's catch-up contributions. And we'll cover this in just a little bit as well. All right, next slide, please. Roth catch-up contributions for highly paid individuals continued. If a plan adds the employee Roth provision, it must be available to all participants and not just the participants who are subject to the HPI Roth catch-up requirements. And that was because maybe there were some plans that didn't want the administrative burden of the Roth feature, but they're going to have it anyway if they have HPIs and just want to limit it to HPIs. And it cannot do that. That's discriminatory in nature. Now, important, if your plan has brokerage accounts, and you have identified individual as an HPI who will be making catch-up contributions, we strongly recommend opening a separate brokerage account for the Roth catch-up contributions. This is going to simplify the trust accounting process when a distribution is requested, when the annual trust accounting is being completed. If the Roth and the pre-tax contributions are in one account, a valuation of that account will have to be done and completed in order to allocate the earnings to Roth and the earnings to pre-tax separately, because as mentioned, you have to track the basis of the Roth contributions. All right, next slide. Okay, so we know that this is the first year for it coming up. Everyone's tried the best they can to prepare for it. But what happens if correcting catch-ups for HPIs that were contributed as pre-tax? So the W-2 correction, and this method is really considered the simplest, but it comes with limitations. The plan simply transfers the affected elective deferrals plus earnings that should have gone to Roth from the participant's pre-tax account to the Roth account. And then the employer then corrects the participant's W-2, reporting the contributions as after-tax Roth. Well, what's the catch? But it comes with limitations. This method can be used if the W-2 has not yet been filed for the year in question, meaning it's certainly a viable option for non-calendar plan years, but for calendar plan years, this means the error must be identified, corrected, completed before W-2s for that year are issued. So this becomes really action critical if this is the correction method that you choose to take when fixing the pre-tax contributions and moving it to Roth. Now, there's another method. The in-plan Roth rollover, which we discussed earlier. In most cases, this will be the primary method and correction approach used when catch-up contributions are mistakenly treated as pre-tax instead of Roth. The plan transfers the incorrectly allocated deferrals, adjusted for gains or losses, from the participant's pre-tax account to the designated Roth account. And then the transferred amount is reported on Form 1099 as includable in the participant's income for the year of transfer. And that's something that your record keeper will do for you. So the only thing you need to do is make sure that you have that provision in your plan. And if you don't, for anybody that wants to do that, if it's just HPIs and a correction is necessary, we'd have addressed that with your plan document as well. Now, this method is similar to the in-plan Roth conversion that we covered earlier. All right, so let's move on here. Pardon me. What NOVA has done to prepare for the new Roth catch-up requirements. Okay, as the document sponsor, NOVA has adopted an amendment to the basic plan document on behalf of our clients to provide for a deemed election for Roth catch-ups. So it is a deemed election, means that there doesn't necessarily have to be a physical election by an HPI who's making catch-up, but this is for the behalf of the plan sponsor to make sure that the plan is administered in accordance with the new regulations. So if they don't make an election, those catch-up contributions must be made as Roth catch-ups, and that's the reason for the deemed election. Now, with this amendment, it also includes a provision for in-plan Roth rollovers for any corrections necessary for HPIs. But that provision, that in-plan Roth rollover amendment, is only applicable for plans that do not currently have that provision, and those that have that provision can now use that to correct any pre-tax that should have been catch-up contributions. And we've given you and delivered you a summary of material modifications and delivered for you to deliver to your participants regarding the amendment. Now, generally we give you a summary plan document or an SPD because we usually just restate the plan for any amended information that you want to have done to the plan. Well, the difference is this happened so quickly in the latter part of this year, the document level language to restate the document was not available. But to make sure that we had everything in place for the January 1, 2026 plan year, we amended the basic plan document, which includes the amendment at the end of the document, and the SMM can be located on our plan sponsor link under Plan Documents, Legal Plan Files section. So if you've not yet delivered your summary material modifications to your participants, please go out to Plan Sponsor link, download that, and deliver it to your participants. All right, moving on. What NOVA has done prepared, continued. Now, if we recently amended your plan to allow for Roth contributions, we've updated the Roth source availability at your record keeper. So prior to that amendment, the Roth source was not available, but we've done that for you, so there's nothing you do with your record keeper to make Roth available. We've also prepared a notice for you to deliver to any participants, pardon me, 50 or older whose FICA W-2 Box 3 compensation exceeds $150,000 in 2025. We also provided you with a plan sponsor checklist to assist you in preparing for the new mandate. What do you need to do internally? Check with your payroll, check with your record keeper. What about your participants? So we will cover those here in just a minute as well. Now, let's move on to annual administration. So part of our annual administration will now include testing your plan to ensure that no catch-up contributions for highly paid individuals, HPIs, were made to the pre-tax source. And to facilitate this testing, we're going to be requesting FICA wages Box 3 of the W-2 on the employee census as part of the year-end data collection. Now, this is not going to only allow us to accurately test your plan, will also provide us with the information to identify HPIs for 2026 in a report that will be included in your annual compliance package. Currently, when we receive our annual compliance package, you have a listing of HCEs, so you know it's going to be considered an HCE for 2026. Well, now we'll have the ability to provide you a report to tell you who's going to be HPIs for the following plan year, and the current plan year as well. So, and if you discover an operational failure, anytime, please reach out to your account manager. We are here to help you. Now, let's go on to annual ADP testing. Now, for certain plans that do not have a safe harbor provision and require ADP discrimination testing, unused catch-up contributions can be used to help pass the test by recharacterizing elective deferrals as unused catch-up contributions for certain HCEs. The option is available, but since most HCEs are also HPIs, the recharacterization of the elective deferral must be done as Roth. And the timing is crucial here because this must be done within the first 2.5 months of the following plan year. Now, to HCEs, most HCEs are also HPIs. Well, with the HCEs, it is not only recognized by compensation as we discussed, but also family attribution. So you can have HCEs if your spouse or a daughter or son work for your company and they're considered an HCE, but their salary is $80,000, they're not going to be an HPI if they don't have $80,000 in FICA wages in the Box 3 of their W-2. That's another great reason to provide us with your year-end data as soon as possible, just so we can get, number one, any testing done on a timely basis, because March 15th is the deadline for refunds, as all of you with non-safe harbor plans know. And in addition, to be able to provide you with a report showing who the HPIs are for 2026. All right, moving on. Actions plan sponsors should take with your payroll provider. Super catch-up contributions. Those are new for 2025. Not all payroll providers are fully aware of it. I would contact your payroll provider and make sure they have the ability to administer the new super catch-ups. And the deferrals are not capped at $31,000 for 25, but they get an additional $11,250 in catch-up. So if you recently added a Roth provision in your plan and expect to have HPIs, make up catch-up contributions, and then contact your payroll provider as well to make sure that they can support that and make sure that the deduction code is available for those contributions. Now, the other thing is, when do I turn that feature on and off? Because payroll companies are different. Some of them you can say, okay, I'm going to go ahead and turn that feature on now, literally at the payroll level when you log on to their site, and it will be effective 1/1/2026. Other payroll companies say, well, you can't switch it until January 1, 2026. So check with your payroll company, see which one you need to take action on. And then if you have added Roth recently and you have a match or safe harbor match, and make sure the payroll system will match all Roth catch-ups for HPIs, excuse me. All right. Other plan sponsor actions. So first, we're going to review the 2025 W-2 Box 3 FICA wages. You should be able to get a report from your payroll provider that has this information. And obviously it's not going to be till January after the year end, but as soon as you can get that, identify who those individuals are. So in early January, review the participant elections for those HPIs and see if participants have elected to contribute more than pre-tax catch-up limit of 24.5. Because if they have, that's going to be Roth contributions. That's going to be Roth catch-up contributions. And you might want to periodically monitor the plan for HPIs that may have exceeded the limit or are close to it. There are some people, I know there's going to be some participants out there who are going to say, no way, I do not want to have anything Roth. So it's good for them to know as soon as possible and to identify them as soon as possible that, hey, if you contribute any more to the plan, it's going to go in as Roth. And then make sure your first payroll submission of 2026 for any new Roth additions to our group here, that these contributions have been elected. So make sure your payroll is ready for those Roth contributions as well. All right, moving on. Participant communication. So we want to communicate the super catch-up option, that's ages 60 to 63, may contribute an additional $3,250, which is a total catch-up of $11,250 in 2025 and 2026. So also, let's inform the participants who are age 50 or over and had compensation that exceeded $150,000 in FICA. In 2025, their catch-up contributions will be made as Roth. Now, the current record keepers provide enrollment kits in paper form, and a lot of them have moved to digital online enrollment kits as well. But if you have written enrollment materials, we recommend going ahead and discarding those kits and go ahead and order some new ones when they're available from the record keeper, because they will have the Roth catch-up provision in there for them to elect. So instead of having to be a deemed catch-up, they elect the catch-up. It's always good for the participant to know where their money is going so they don't have any surprises. All right, and once again, please distribute an updated material, summary of material modifications, and this SMM again is located on Plan Sponsor link under Plan Documents, Legal Documents, and named Roth Catch-up SMM. All right, moving on to participant actions. Okay, well, you're not eligible to make catch-up contributions next year and you're unaffected by the new law, then no action is required. You will not be 50 years or older by the end of 2026. You can't even make catch-ups. And I mentioned earlier, what if a participant does not want to contribute anything as Roth? Well, first of all, we discussed the ADP testing and recharacterization of unused catch-ups. So if they don't want to have any Roth, and you might be a situation where the test is going to fail if you cannot recharacterize any of their catch-up contributions. If you run into that situation, that's probably a good conversation to have with your account manager and the participant to let the participant know that, hey, if you don't take these catch-up contributions as Roth, we're going to fail the ADP test, and other highly compensated employees are going to get refunds. So that communication, I think, is very important to have with them as well. And then have your updating your deferral elections, getting those election forms from your record keeper. And so they can elect the payroll deduction of catch-up contributions to be as Roth. And, that way they know that they've done it. They're aware of it. There's not going to be any surprises for them at the end of the year. They're not going to get a statement from the record keeper and say, I didn't put any Roth in there. You never want participants coming back and saying, what'd you do with my money? So the more we communicate with them and the more they do as well by being proactive and taking care of this on their own, I think will smooth the transition over to these new regulations. All right, next slide. Close it. Okay, Nova's here to help. These regulations came out some time ago, and we've been working on this diligently since, I believe, July, and trying to provide you with much information as we can on this. But if you have any questions about anything, please contact your account managers. Like I said, we're here to help. In addition, as Ava mentioned, if you've got the PDF of this presentation, or if you're unable to get it, contact your account manager. And then we're going to have a deeper dive into the Roth catch-up on December 4th at 1 p.m. with my colleague, Craig Hoffman, who's an ERISA counsel. And if you want to attend, the link to do so was sent to you from our account manager between November 17th and 19th. And if you can't locate the emails, please reach out to your account manager. And then you'll be able to attend the one on December 4th for more about Roth catch-ups. And so you can see this webinar we've done here in another day or so, and other informative webinars on our YouTube channel, as Ava mentioned. And there's the link. And it's just, you can search Nova 401k in YouTube. Again, Ava, thank you for your assistance. And I want to thank all of you for being here. I certainly do appreciate your time today. And I wish everyone a safe and holiday season.
Thanks, David. David, do you have time to answer a few questions since we have a little bit of time?
Okay.
So let's see here. Where can they find the materials that you mentioned about the HPI notice and the plan sponsor checklist?
Okay, I would check with their account manager. They've been emailed to them, but we can certainly do that again. Okay, so just reach out to your account manager and they'll get them over to you.
Okay. And then does the rule of 55 apply to Roth 401k contributions?
Okay, read that one again.
Does the rule of 55 apply to Roth 401k contributions?
That I do not know, but I will find out and I will respond to that one.
Okay, so if you want to send that question to the webinars, then we can get that answer for you. And then okay, that looks good. And then if your question wasn't answered, just send us an email at webinars@nova401k.com and we can get those questions answered for you guys. Thank you guys so much for attending today's presentation, and thank you again to David.
Thanks, everyone.